Welcome everyone to this webinar. So today we're talking key performance metrics, and we've talked about that in a lot of different webinars. It's something really important. We're talking specifically about cannabis retailers. Anyone who works with cannabis retailers, I think you're going to be really excited to hear all this information. And for people who may not work with that specific group, I still think understanding performance metrics, a lot of the things that we do are similar across different industries. And so I think you'll really find a lot of value in today's conversation. I'm Tom Waddleton. I work with Summit Virtual CFO by Anders. Let me tell you just a little bit more about our company, and then I'm going to introduce our speaker. Guillermo, if we can jump to the next slide. So Summit CPA Group was started a little bit over 20 years ago as a traditional CPA firm. So audits and tax work that we did. In 2004, we started offering VCFO, virtual CFO, and back office accounting services to clients. You can go ahead and progress the slide if you want, Guillermo, a couple forward. So we started doing that with people. And then 2013, we became a fully distributed firm. And around that time was where we really doubled down and said, okay, the virtual CFO practice is really where we're going to focus. And that's going to be the main thing that we do. We were excited last year that we joined Anders CPA and Advisors, a St. Louis-based firm. And so we're now Summit Virtual CFO by Anders. We're very excited about what the two companies together can bring and what it can do for our clients. So let me tell you just a little bit about our speaker. Guillermo Rodriguez is my peer as a virtual CFO. Guillermo, welcome today.
Thanks, Tom.
I know that you're helping us develop the cannabis vertical that we have within our company. Can you introduce yourself a little bit and tell us your career story and how you got so interested in this and kind of your background there?
Sure. Yeah. Just a quick introduction. I'll try to keep a kind of the 3-minute version here, but my name is Guillermo Rodriguez. I'm one of the virtual CFOs here at Summit Virtual CFO by Anders, and I head up our what we call our cannabis vertical and work with cannabis clients. You just quickly professional experience. I'm right about 20 years of working in accounting and finance. And like most accountants, I started working in financial accounting, doing financial statements. I worked in corporate for a very large contractor based out of here out of San Antonio, but we were doing nationwide construction projects, and worked in financial accounting and internal audit for the first half of my career, kind of doing historical stuff, producing financial statements and looking into the past. I think what really changed in my career was kind of like halfway through my career is I had a chance to go into corporate finance. So now if you know about these types of roles, finance is more of getting deals done, looking into the future, managing cash flow. And the way I got into that is the business I was working with, we were going into acquisition mode. So we were looking out to buy a business. And so it's something we do with our small business clients as well. Anytime you apply for a loan, you got to do a pro forma of the acquisition and what that's going to look like. And the bank wants to know that to do their underwriting. But we're doing this on a very large scale. And even for a large company, we didn't have a process set up. So I got our forecasting process set up. And I think that's where I could really, then I started to see, the power of forecasting and what we do for our clients is helps people look into the future, get comfortable with decisions, make more informed decisions. And that was really a big part of growing the business. And so that second half of my career, I went into corporate finance, and then eventually how I got into cannabis is right around the pandemic year is when I had a chance to kind of reassess things and wanted to make a change in my career. And through some personal things, I was teaching yoga, I was studying Ayurvedic medicine. I realized that, my passion was health and wellness. And I found that, cannabis, I was frustrated with, during the pandemic, we had a platform to talk about preventative health, wellness, and it wasn't really being done in my company. So I said, I want to be part of a role where I can push policy forward, where I can move things forward for people who want to use plant medicine. And so, of course, as a virtual CFO, I focus more on helping companies be profitable. And I felt like that's my role, and especially with retailers, to create a very healthy supply chain. I think the retailer is at the focus of that, because retailers need to be successful to keep a healthy supply chain going forward. And so, now I work with cannabis companies, and decided to change my career into more of a client facing role, and that's what I'm doing today now. So happy to be a
Great.
part of that.
It's great to hear all your experiences through your career and then coming into a personal passion. And when you can put those two together, it's really cool to keep using those skills and doing that. So let's go ahead and get into this. The one thing that we'll do from a framing perspective, people may have heard us talk about profit focused accounting. And so a couple of things that we'll mention, and you're going to give some really good examples of this with with the cannabis industry that we had, but a real focus on helping people accomplish their goals. And the non-financial drivers, you're going to give some really good examples, but we think that's one of the most powerful ways to help our clients speak in their language, the non-financial parts, and maybe more importantly, the things that we can measure and that they can control. And so it's great if someone says, I want to make this much profit, or I want to grow my top line revenue so much, when you can break it down into what that actually means by selling a certain amount of products or services at a certain rate and things like that. All of a sudden you can say, okay, are you doing what you said? And at that point, then the finances actually become just a byproduct of that. So I mentioned metrics, having really clear metrics, and Guillermo, you're going to give us some examples of those kind of things. And then we're also going to specifically talk about the pipeline and then also the forecast that's in there. So just for framing, that's when we talk about virtual CFO and kind of our approach, this sort of summarizes the whole thing, and we'll give you examples. So do you want to tell us how we're going to walk through today's presentation?
Sure. Yep. Let's go through the agenda. And hopefully by the end, the goal is that, you understand how all of these different areas work together to drive profitability. And more importantly, that you can identify behaviors, actions that you can take, and also using this historical information to manage the business, to look over your metrics and improve profitability over time. But we'll go over really concrete examples over that. So just to quickly go over our agenda to understand what we're going to be talking about today, we're going to talk about cash. Many times our clients ask, how much cash do I need to keep on hand? What's a number that, I can sleep at night? We'll go over what those numbers look like and how to park that money in different bank accounts and how you could do that. The second piece will be production metrics. So if you look at your income statement, we're really talking about sales minus the cost of your product equaling your gross margin. So we're focusing on how to increase that gross margin number there through sales optimization, basket size, all the things that we talk about in the retail world, but really how to measure that and how to improve those numbers. And finally, historical. So Tom mentioned, we focus on the future. So yes, we have to produce historical financials to then benchmark your gross margin, how much overhead you should be keeping. But the point of the conversation is to see how we can improve those numbers through these other various metrics that we're going to be looking at. And lastly, pipeline. So in retail, we know that customer retention is low in general in the industry, but how do you measure your customer retention and improve it over time with the experience that folks have when they come into your store and buy your product? So we'll talk about how to measure those metrics and track them. So quickly, let's go into cash. The reason that cash is so important to talk about within cannabis is because capital markets are tight right now. The recent news of the possible rescheduling of cannabis from 1 to 3 is huge, because kind of another way to think about it is that additional cash flow from just having a normal tax rate is going to bring in a ton of more cash flow into the industry. But regardless, on the capital side, it's a tough time. And so building cash from profit is going to be your source of building capital within the business.
Guillermo, some people may not be completely familiar with the moving from Schedule 1 to Schedule 3 and what that means. Can you give a really quick overview if you lost someone there?
Oh, sure. Yeah. So there's really two paths to rescheduling. So cannabis is now Schedule 1. So Schedule 1 and 2 subjects the operator to 280E. Basically, you're not able to deduct overhead expenses, and results in a very high tax rate. And so you remember the president called on a review of the scheduling of cannabis. So now is recognized as having medicinal value, something that we've all known for a long time, but now it's being recognized at the federal level. So if this reschedule happens, so the Department of Health recommended to the DA, that's the process to review it. Then it goes through this very long process into eventually rescheduling. Essentially, at that point, 280E would go away for the operators in the year that it gets placed. And so that's why I say, profit after tax would be much higher, after this reschedule happens. But for the time being, we're going to assume things are as they are for the purpose of this presentation. I think we're looking at a possible next year or the following year if things go well, which I think most feel confident that they will.
Perfect. On this slide, so then there on the right, 40% of forecasted gross profit being your current tax amount that you have to have on hand, cash on hand for taxes, could switch to being net income if it happens the way you're hoping that it will.
That's correct. And that's what we're advising, continue to plan next year and build your cash reserves as if you're still, under 280E. And so that'll be the advice that we give there. And how much cash you should keep on hand, it's going to be 10 to 30% of revenue. And yeah, as Tom said, 40% of gross profit could be a little bit lower depending on where your tax rate is, but we use the more conservative 40%. And simply put, it's if you want to see the calculation, 12 million, if you're a 12 million operator, that's 10%, that's 1.2 million. If you're on the 30% range, more conservative, you're at 3.6. Now you may ask, well, what makes me a 10 versus a 30? That's what we're going to go on the next slide. So if you want to be more conservative, you have the things that you may need to look at is if you have low reoccurring revenue, or you have partners that you're going to want to buy out in the next coming years, or you have multiple partners, the possibility is always there. Or if you have low liquidity on the personal side to invest back into the business, you want to keep the discipline of keeping the cash in the business. Now, if you have very high reoccurring revenue, you low growth, you have the liquidity to push back in the business, you can probably get away with more of a 10%. And it's kind of like, this is a bit qualitative in as far as how we come up with the 10 to the 30. We look at a detailed formula of your cash conversion cycle, but just to keep things simple, we say 10 to 30%. You'll see on the next slides how we come up with that 10 or 30%.
Yep. I'm glad you mentioned that. Many people, as we share this with new clients, they'll talk about, well, I've always heard that it should be maybe 2 months worth of operating expenses, excluding these things and those things. And that can work. These calculations, 10% often comes to about 2 months worth of operating expense. And I think you hit on a key thing. It's a very simple number to calculate. And you can get yourself really twisted around trying to calculate a number and kind of lose sight of what you're really trying to do.
Yeah, and this is kind of a shortcut, right, Tom, just to get you to how to think about it, and where you should put that money. So we're going to think about 3 separate accounts. Now, in cannabis, another big news. It's hard not to talk about this stuff because there's so much big news coming out, but so the Senate Banking Committee just voted positively on in favor of safe banking. So you could possibly see more banks entering the space. But the reality is that most cannabis operators have access to banking through some state chartered bank or credit union for the time being. But what safe banking will do is it'll, one, create more capital possibly as more banks get into the space, but could lower some fees. But, as we sit right now, this recommendation still applies. I mean, you can get access to an interest-bearing account and a bank account with the current environment. What we recommend is the 10 to 30%. We recommend putting that into, to Tom's point about how many payroll cycles. We're going to recommend 2 to 3 payroll cycles in your operating account. Any excess of that total 10 to 30%. We'll put in a cash reserve account that's more interest bearing, and you can start moving money into that account. The reason for being is just to get some some return on your
Yeah.
cash balances there, of any excess cash you may have. And the third one is your tax reserve account. The main emphasis that we want to put here is that this is not a allocation on your balance sheet. We recommend the movement of those funds into these accounts to develop the discipline of having those balances there ready. So we'll go into how to calculate the tax reserve, but you want to put that money into a tax reserve account so that it's ready at the end of the year in case you have a tax payment.
Yeah.
And how do we come up with that 10%? So we talked about the formula. Just very quickly, it is your annual revenue divided by the days in the year. So you come up with your daily revenue. And if you look at your cash usage for a retailer, it's the days that your inventory is outstanding minus how long it takes for you to pay vendors.
Mm-hmm.
If we're carrying 60 days of inventory, paying on average 30 days, we calculate our daily revenue, we come up with the 986, and boom, that's how you get to your 10%. So that's where we say, okay, 10% covers about the 30 days there.
Yeah.
And lastly, tax reserve. I touched on it on a previous slide, but now we're going to go into how to calculate that number, how to make estimated tax payments to ensure you're properly tax planning for the year. So here's an income statement of an operator doing about 12 million in annual revenue. I drew the dotted line down below to say net income. And then we're like, oops, we're going to be paying tax on essentially gross profit at this level. So if we calculate our annual tax reserve, our tax for the year, it's going to be the gross profit times 40%. There could be a lower tax rate, but we're just going to go on the high end there. And that's how you come up with your estimated tax payments of $540 per quarter. Now, to make those tax payments, they're going to be due on the various due dates set by the IRS down below. Your accountant probably set you up with some kind of a coupon to make those estimated tax payments. And what we have here down below is we have the calculation of the 5.4 times the 40%, and we're saying, okay, we're paying $500,000 per quarter. And by the end of the year, we see that we're slightly under 160 on our tax reserve. But essentially, you're going to want to make those estimated tax payments every year and then be funding that tax reserve account as well.
Yeah. And we found this to be such a good, and if it's not that seasonable business, your 540,000 per quarter is going to be a monthly payment. And so it's just an amount that they put in, and then the payments come out, and sometimes you have a balance in there. And we found that to be the best, as opposed to mixing the cash in. And then you get to a point where maybe the owner sees a large balance in there and has some ideas of using that fund for personal, take it out of the business or do an acquisition or something. And then you're the one who comes forward saying, hey, let's write a check for $500,000. And you just wrote one 3 months ago. And they just hate that kind of conversation. And so this is a much better way to go ahead and put those dollars in there.
Yeah, nobody likes the surprises. The nice thing that could happen about this reschedule we're talking about, Tom, like I said, let's say it happens next year, you're still building up this tax reserve. Yep. that you could just move back into operating if the reschedule happens. Your tax liability be much lower, given a reschedule happening next year.
Right.
Okay. And then lastly, I'm sorry, let me go back one. Lastly, the LOC. So usually we'll recommend a line of credit equal to this 10 to 30% number. Now it's much more challenging, much more costly. Capital in cannabis is like basically at credit card rates at times. And so it may be difficult to get this LOC up to the number that we want, but eventually that is what you want to do. You want to match it to this cash reserve and be able to come up with a nice cushion there. And lastly, what I want to say about cash planning is that it can lead to lost opportunity, because I think what we're seeing in the next couple of years, where there's so much progress, or right now valuations for companies are very low, The promise of the industry is that we'd have a lot of these small players that are able to build businesses, to build legacy. Um, but because of the environment with the taxes and regulation, you're seeing a lot more consolidation. And so the opportunity is just about there in terms of a regulatory that environment that could make profitability more possible. And so you can't really get there without proper cash planning, without having the right reserves and being able to overcome lack of capital in the next coming years. And so it's extremely important to be able to plan and to build cash in the next coming years.
Yeah, I like the way you say that. I often talk to my clients about just that cash gives them flexibility. If you're in a very difficult time in the business for some reason, having the cash at least allows you to make some choices. And if you have no money, you don't have the chance to say, maybe I hold on to my staff through a difficult time or invest in advertising here or other things because you can't afford doing that. So I like the way you're saying that. Those are those lost opportunities that at least the cash makes it possible.
Yeah, or selling the business much sooner than you
Yeah,
wanted to at a multiple
sure.
that's not what you hope for, and so we
Hmm.
want to completely avoid that. And next is financials. The conversation here is focused on what your financials should look like. One, from a point of how you should organize your accounts, so that you can review it and actually look at the metrics that we're going to be talking about today, and benchmarking. So what should gross margin look like, overhead, that type of thing. Net income as a percentage of revenue is somewhere around the 20% of revenue mark
Hmm.
industry wide for retailers. How we came up with that is just looking across a lot of different clients, and the research shows, polling all retailers, is that about a third are profitable. And of those that are profitable, what you see on the right here, they're at about a 20% gross margin. So going back to the COVID year, you can see a lot more profitability. 2/3 of retailers are profitable, about a third are profitable now. And so for the industry to be healthy, we got to get that number, that green, much higher overall than what we're seeing right now.
Yeah, that's a
Because,
challenging trend to look at that, right? From 66 down to 57 down to
oh
31.
yeah,
That's a real hit for these guys.
yeah, 2022, a lot of demand uh, during COVID, and then just more licenses, more competition
Hmm.
as we get closer to the current year. And so that trend's going to continue. But again, we should see some relief from 280E and just operators becoming more sophisticated in their
Hmm.
pricing. And uh, what should your overhead look like?
Uh-huh.
We just talked about net income. Let's just walk through the whole statement. Profitability. Sometimes we talk about price compression. Sometimes that is passed on to the retailers. Sometimes the brands are feeling it a little bit more. Um, but as a whole, 50% gross margin is probably about the highest. And then when you apply discounting, price compression, 45% is a very healthy number. Anything lower than that indicates a high level of discounting, and price compression, competition, what you're seeing right now. Um, think of your overhead as three categories: administrative, marketing, and facility. Um, and those percentages are somewhere around, admins usually around 18%, low marketing, although you have some operators that are spending more on marketing in terms of events and stuff. And then your facility cost is your rent and your security at the dispensary. So those are the kind of the basics of what your financial should look like. And then if you're at a 40% tax rate, at gross margin, you're really at 3% after tax. So you can see low profitability, even at a very healthy margin, and about a 25%
Hmm.
overhead number. The expense groupings is you'll just have all of your cost of goods sold for your different categories within cost of goods sold. That's your income statement. So all your different brands will go into COGS. Discounting is not included here. It'll be
Hmm.
down below. And as I said earlier, marketing, admin, and facility are these percentages you see here.
Hmm.
And so marketing could include your weed maps, wages if you do have a marketing person, and your admin is basically all your other people. So there are no people up in cost of goods sold. And then the facility is your security and rent expense.
And you're demonstrating also the value of benchmarking. information, right? When you've got 2/3 of the people being unprofitable, if you can look at ones and say, here's what we would expect you to be spending, and then you can find if your company's unprofitable, where is it that you're not in line with some of those benchmarks, can give you a really good area to focus on.
Sure, just specifically, right? I mean, scaling
Hmm.
into your rent, depending on the square
Yep.
footage, or looking at the industry as a whole and seeing what's the revenue per employee, right? We've seen
Hmm.
some as low as 200,000 per employee, all the way up to 500,000, and so there's a wide range there in terms of the efficiency of those people.
Yeah.
Um, and then just lastly, want to emphasize we don't break it down to this level on the income statement, but when you're adding people, uh, you want to be able to calculate a burden rate because there's a cost of the salary as well as any health insurance, 401k match, and all these different categories that you'll want to calculate when adding additional employees into your overhead.
Hmm.
And as I said, here's the slide. I memorized the numbers. So here's the average of revenue per full-time employee, that you just get an idea of kind of where your overhead should land. Okay. And now we're going to
Excellent.
get transition right into our production metrics. Let me see where we're at on time.
I think you're doing really well.
24.
We're
Okay.
close to halfway through.
Okay, good. So going into production is we can't avoid talking about price compression because that is the challenge, and that's what retailers are dealing with right now. Is that price compression basically means that the average price per item is much lower. Consumers are shopping around for the lowest price. They're buying on price, not as loyal, and they're looking for value. Um, and you can see it across different markets since 2021. Average price per item has just declined. That equals lower profitability for retailers. And if you look at it by the hardest hit category, which would be flower, you have the same story, is that there's a decline over the last couple of years. So the challenge for a retailer is how to, despite this environment, to increase the average size per basket. This is essentially what this is telling you. This is telling you that the average transaction is going to be lower. If the price per item is lower, um, consumers may be even buying more, but it's offsetting the additional revenue.
If you go
Um,
back to that for 1 second, Guillermo, if you look at a state like Michigan, that's the one that stands out as the most significant drop. Can you tell a little bit about maybe what's going on in Michigan, if it's similar to other places? I assume
yeah,
competition is probably one of the things, but what is it that drives that down so much?
yeah. So Michigan is it's more of a, so the older the market, the more legacy the market is, like California, Colorado. Michigan is one of those. The larger markets, they've been hit harder because there's more consumers and there's more licenses in those states. So Michigan is really a kind of a poster child for this kind of erratic pricing that's been happening, because you can see that it is even a bit erratic in the margins. That and it kind of tells you that retailers don't really have a consistent pricing model. So I just heard in Michigan they are starting to put a cap on the licenses.
Mm,
Um, but this has a lot to do with the number of players that are coming into the market and just heavy competition
okay.
and the
Okay.
demographic of the consumer in that market. So we have folks that are really high, shopping on the, trying to find the biggest value. You have
Mm,
you have industries like you have states like Maryland where you have maybe more of a, think of Maryland, you have a lot of politicians, a lot of like
uh-huh.
government people. They actually are shopping like in the stores. They're spending more money, and it's a different class of customer than what you see in
Interesting.
Michigan. Yeah.
Okay. Very interesting.
So basket size, this is going to be the key metric that we want to track within our production to
Uh-huh.
increase profitability. And sometimes we'll call this AOV. That's what you'll hear it say, AOV, average order value. And it's your total sales per month times your total transactions that are coming out of your POS. And the average basket, which we just talked about, it's like you can see it declining. Again, let's use Michigan. 85 is a really good number. You can really
Hmm.
make profit at that level. But when you start getting down into the 60s and the 30s, that's really kind of a danger zone. And it's really tough to have profitability increase your transactions to offset that low basket size.
Okay.
And you have times where, as a market, sometimes transactions are up, sometimes basket size are up, like you had during the pandemic and people stocking up. So that's something to just keep in track as we're looking at this. Also assess the situation, what's going on in the market, to see if the overall market is trending down on basket size or transactions. And what influences basket size is just simply the items and the price. And so pricing is going to be affected by the level of discounting, right? And as I said, we're going to talk about some of the kind of the concrete ways to increase basket size. And this is the non-financial drivers of behaviors that Tom referenced at the beginning of the presentation. But we have two. There's many. We're not going to go into all of them, but cross-selling and upselling are two of the strategies to increasing basket size. Where cross-selling is suggesting additional products, and upselling is more premium products. But of course, it's up to the bud tender to be educated, to know the consumer, to have the right technology stack, to look at the POS and know what customer they're talking to, what they bought last time. And so the technology around this is huge, as well as the training of your bud tenders, because we know there is, I heard it this week at the Benzinga Capital Conference, is that the turnover rate is at about 90% for bud tenders. So very important to, as another KPI, to be training your bud tenders to know the customers and use the tools that you've set up for them.
Figure on retention. Guillermo, I'd love you to talk. These are great metrics. Any specific clients you can talk about? And I'd love to hear sort of where they were in terms of measuring these kinds of things when you started working with them, and whether you played a educational role in like teaching them about these, or were you coming in saying, okay, let's look at, you guys already knew these were important metrics, you're just using those?
No, I think for the most part, clients aren't using the tools and the pricing. It's been kind of more of the suppliers have been setting the prices, or the big one right now is AI. There's a lot of AI around the POS system that makes recommendations around the products. And
Okay.
I would say for the most part, the dispensaries are not taking full advantage and looking at every transaction to be able to see how they can improve their pricing and have better profitability.
Okay.
And so a lot of room for improvement for retailers here.
That leads into this example where we can model and show them, hey, here's
Yep.
the impact of doing something different that you can give an example of.
Exactly. So here's an example that I just quickly put together, so you can see the impact of these non-financial drivers of asking the questions. Pre-roll. Again, I was at Benzinga, and I just saw. It seems like I talked to so many pre-roll manufacturers, vendors, because it is just such a fast-growing category, and just a potential for growth there. And so, like, if we look at an example of a retailer doing about 16,000 transactions per month, at an average of 61 for basket size, we're at revenue of 1.1 million, 16,000. And this is a upselling, a cross-selling opportunity, is where you train a bud tender to say, would you like to add this item, pre-roll in this example. At a 10% conversion rate, you'd see about a $10,000 increase in monthly sales. But what I want to point out here is that, basket size is really, this is a $6 item in this example, is that it's only $1.60 increase in your average basket size. But over time, if you look at a 5-year impact, I mean, it's over $600,000. 5-year impact. And this is just one little example of how to increase a basket size, And so this is where you would track and see what is working, what's not. How is this conversion rate changing, and adding more of these cross-selling and upselling opportunities into your point of sale experience. And so the main 3 levers, like we again, I'm always going back to Tom's intro there, but what are the things that we can control? And we call
Uh-huh.
these levers. And the levers are the discounting. How you manage your basket size is by optimizing your discounting only to the point that it's increasing, producing incremental sales, right?
Hmm.
Um, we talked about a couple of ways to increase basket size and then driving more traffic into the retail store through marketing, through follow-up messaging with your consumers. Again, all these tools are, you can link up into your um, point of sale system through a sales optimization platform. But these are three levers of things you can actually control and drive higher profitability, right?
Hmm.
And to give an example to kind of just bring it all together is if we look at a forecast where we have a basket size of $71 and improving that $10 over time, and then we're improving our daily transactions from 463 to 507. So again, when you kind of drill down, this doesn't look like a huge improvement, right? $10 on average,
Hmm.
you're about 40 more transactions per day. Um, we're doing this in our existing facility. It's a 12,000 square foot facility in this example. Well, then um, we get to a gross margin of 35 to 45%. But what you can see is that this is the path to getting from net income of 250 to $1.7 million. And if you just look at the financials, it doesn't really tell you how you got there, right? You got to drill into these very specific metrics that we're talking about today to see how do I get from a 250 net income to $2 million, right? And how does that look like on my financials? And so this is a
Hmm.
forecast to just kind of bring all that together. Um,
And what I
and
liked about that, Guillermo, that you mentioned, the examples that you gave, at least in the previous slide, are very much where you can say, what actions you're going to take to make that happen? How are you going to try to get $10 more per basket? And how are you going to try to get more baskets that are coming in? And you can see a management team brainstorming multiple ideas. I'm curious, do you have any clients that you can think of the kind of things that they did and would love if they tried something that didn't work, so they tried something different as they measure what they try to do here?
yeah, I think a lot of it is around, one example is the big talk in the industry is about innovation. Like I think that's kind of a
Hmm.
buzzword,
Sure.
and innovation is really about improving the customer experience, improving the experience whether it's in the dispensary or the product itself. Um, One of the ways that I've seen some of our retailers improve is through uh, packaging or different THC levels. So there was one
Mm.
retailer. This was in Colorado. One of the first that um, experimented with low THC, right? And so we already know the market of consumers that purchase on very high THC, but the low THC soccer moms, what have you, that market hadn't been tapped. And
Oh,
so, changing the dosaging, the levels in the product, it really opened up a big market for that retailer. So there's examples after examples, and it looks tough market overall, but there's a lot of retailers and brands that have been very successful just by innovating the customer experience and discovering new customer segments, just like that one.
I love that example. And you had mentioned to me before that retail cannabis companies know their customers really well because customers have to register. Is that right? So if I come back to the same place over and over, they know that it's me coming back where they can say, if they put me in this particular category, and we're going to try this with them, is it working? And let's take all those people that we're thinking are in that low THC category, like you suggested. And
Right.
you could look and say, yeah, we tried that for 3 months and it didn't do anything. So we're going to try something different. Or that was a home run. How can we apply that elsewhere? So yeah, I think you gave a really good example there.
That's right. You gotta really know your customer. There's a difference
Hmm.
between the consumer that's like we just talked about, or you don't want to offer them a very high a concentrate or something in a different category, but uh consumers who purchase flower likely to purchase, in the pre-roll category. So knowing them, and then you have states like, go back to Maryland where there's limited cultivation licenses. So you really want to be prepared because there's limited strains to be able to sub in the right product in case you're out that's similar to what the customer purchased the previous time, and be ready not to lose those sales. And so if basket size is decreasing for that particular customer, you got to find a strategy to get that back up or keep increasing that value or bring them back in the store if you haven't seen them around in a while.
Okay.
The other piece on this, and I won't go too long, is that, we stopped at the net income level, but, getting to profitability again, after 280E taxes, I mean, this is at a 21% rate. So you can see how we went from a loss after tax to a very slight, profitable company. Now this will drastically change. I went ahead and put at the very lower line what this income statement would look like after a reschedule. It's huge. Like, look at the difference in year 4. I mean, you're making a slight profit to making $1.3 million in profit,
Yes.
once the reschedule happens. So a lot of opportunity there. And then lastly, just to kind of, again, we talk about benchmarking with this metric being so big, just kind of where you're at in terms of your state. These are the average basket sizes for these various different markets that are being tracked here. And you see where, back to your question earlier, Tom, about Michigan, you see the more legacy markets like Oregon, Colorado have much lower basket sizes than the new markets like Maryland that just came on this year, or Illinois. And let me see. And again, just we talked about discounting as a lever. So we wanted just to see kind of where the markups rate were across different markets, and something you could benchmark against. And then lastly, well, let's skip this and keep moving forward. And then lastly, how are we doing on time, Tom?
We've got about 13 minutes left. Yes.
Okay, good. All right. And then lastly, pipeline. So pipeline brings it all together because we can do all these different things. We're tracking our financials, our benchmarks. We're increasing sales, but unless we have a high level of reoccurring customers, it's very difficult to keep growing the business and to keep bringing customers in. And so that's why I say pipeline is really what brings all the metrics together, and it's kind of the foundation for driving profitability. So customer retention rate, again, very low in overall in industry. If you compare it to a consumer packaged goods industry where we're moving forward towards, but not quite there yet. But just to show the formula, how do we look at customer retention rate? It's your customers at the end of the period minus your new customers divided by, where you started times 100%. And that's, there's different formulas for customer retention, but this is one way to look at it. Customer acquisition cost is another pipeline metric that you need to track. And this refers to the total cost of acquiring a new customer, because you want to ensure that the dollars that you're spending, that the customer is actually bringing enough revenue to offset the cost of acquiring them in the first place. And so it's not this metric. We don't look at it by itself. We have to look at it in terms of the value over the lifetime of the customer. So we'll go into how to compare those two things. But what is in your customer acquisition costs? Well, that will be weed maps. Again, there's different ways of, sometimes, you may want to say, I want to exclude this particular marketing cost, but just generally it's all of your marketing costs that go into the calculation. So weed maps, any cannabis content, social media. And I know you might be like, well, what if a customer was acquired through a recommendation from another customer? And that's kind of the nuance around this metric, is that we don't truly know where the customer came from, but we want to use this metric to get a general idea. And what that does is help determine how much money we're going to be spending on advertising, promotion, digging into what marketing channels are actually working and bringing in a positive ROI.
Mm-hmm.
So customer acquisition cost will just be your total cost of sales divided by marketing, divided by customers acquired. Now, like I said earlier, you want to look at this alongside your customer lifetime value. And customer lifetime value is the average transactional value of each customer times the number of purchases they make per year, times how many, maybe on average your customers are 1 year and then they move on. And so getting that data will help you calculate CLV. But let's just say the average transaction is $71 times 14 times per year, then we're assuming 1 year. So that that your customer lifetime value is $994, right, for this customer. And then we look at the ratio. So that lifetime value divided by the cost, we said 994. And let's say the customer acquisition, the lifetime value was 994. Let's just say it cost us $300 to acquire that customer. So we're at 3 times. And industry-wide, we say 3 times is a good number. You want to get to about 3, so
Okay.
that's how your marketing dollars are effective.
Sounds like
And
a
so,
great way to, like you're saying, you've got these metrics if someone's wanting to increase their marketing cost to help them understand sort of what's the ceiling limit that would say, well, you really don't want to go over this because you'll get more customers, but you're going to lose money if you end up spending more than what their value is. And so having that kind of ratio is a really good way to measure that.
yep, you want to just track that and make sure that you're getting an investment or a return on the investment with those marketing
Hmm.
dollars. That's right. And just to summarize, you want to just optimize your metrics. And just to summarize, we looked at customer retention rate, the customer acquisition cost, the lifetime value of those customers. And then again, just to summarize, then you look at the ratio of CLV to what you call CAC. And that really that takes us to the end. So that summarizes the 4 kind of key areas that we looked at. And the point here is that these KPIs give you some visibility into the future to be able to forecast and set targets for the business. And that's why we call these kind of the road signs. They kind of that point you to the right way. And again, we're kind of coming towards the end and wanting
Hmm.
to summarize. The more we can kind of look at these concepts holistically, the better. I think they work together to be able to drive profitability. And so just to kind of recap everything we talked about, metrics, cash, we talked about days in inventory as being one of the key metrics and optimizing the days in inventory. Financial, we talked about net income as a percentage of revenue, your gross margin, and your overhead, really trying to track to that 25 to 30%, and optimizing and growing into your rent expense over time. In production, we talked about basket size, number of transactions, and again, just to summarize on pipeline, customer retention rate, your customer acquisition cost, and your customer lifetime value. And this being really the bucket where you want to look at those 2 things as a ratio and how they're working together. So we're kind of just wrapping up here. In the last minutes here, we've been talking about these kind of 4 main categories. And so these are the performance indicators that we help, especially in cannabis, get to profitability. I mean, it's been some good years, it's been some tough years, but what we found is that these 4 key areas in any industries is where our clients focus to get to profitability. But it's been a tough road. So yeah, I just want to say, just being in the industry is a testament to the tenacity. I think like what we talk a lot about when I go to conferences and I get to talk to kind of all around people in the industry is that what this has really built is people who have owners who have learned to operate in a really tough regulatory environment. And
Hmm.
so it's amazing that, owners have been able to raise capital in this environment to keep businesses going forward. But what I really want to emphasize is that, the promise of the industry is helping small operators be profitable. Sometimes these are very first time business owners.
Right.
And so what we found is that, tracking these metrics, some of the breakthroughs we've seen at the federal levels was what's really going to help the industry move forward. And so I think the ideas that we've talked about today are kind of like the first steps in getting there. And so just want to
Yeah.
kind of commend those who are in the industry and just made it through these first few tough years since the COVID.
And Guillermo, this has for me sort of the so what factor with all the metrics that you had. And one of the ones that was really powerful to me is seeing the shrinking number of companies that are profitable from 60 some percent just 2 years ago, all the way down to, I think, 31%. I would assume when you talk to new clients, that's something that you would really emphasize, that this is a hard business to be in, but you've got a lot of metrics to show them how they can be profitable. And almost a third of the companies are profitable. And your model showed with some tweaks that were pretty impressive, but you could take a company that was barely making money, right? 200,000 on 12 million, all the way up to 1.4 million. That's a dramatic change. Do you get that kind of reaction from clients of sort of, maybe there's a range from this is easy, I just sort of do things, or I don't know how anyone can be profitable, to where you can help both of them with these metrics and say, so here's why you want to run your business this way?
Yeah, I think, Tom, it's been a bit of survival, right? It's interesting that the things that we should be thinking about is like when there's so much going on from a regulatory standpoint, it's tough to think about these things, but this is what you
Yeah.
have to do to be profitable. And so I think what I'm seeing now is that more operators are starting to think down to this level of like, how can I get there? um, when it just felt like there was just so many burdens before, and so
Hmm.
this stuff kind of got pushed aside, of course. Um, and so there's been a more of an embrace of professional services to help owners and reaching out for help. So definitely, I have seen that just the level of sophistication and kind of path towards profitability is being talked about more than ever.
Yeah, I'm not surprised. Well, Guillermo, thank you. This is really valuable, and your knowledge of this industry is pretty incredible. Where I think as a partner, having that knowledge plus the finance skills really helps them a significant amount. And I can see an operator coming in and saying, "I'm just trying to run a business," and you saying, "Well, here's some different ways you could look at it. And if you do these things, let's look and see if we can measure this and see if we're seeing the kind of progress we want to." And then a forecast that says, "And if you do this, here's what the end result can look like." That really puts a nice package together for them.
That's right. Yeah, and just back to the kind of my point is that, we can apply to these concepts anywhere to a brand, to a cultivator as well. But really, at the end of the day, the retailers, they need to be successful to kind of build out the supply chain and have a really healthy supply chain all the way through. And so the emphasis on retailers and increasing profitability for retailers is really what we wanted to focus on today to kind of help the industry overall.
Yeah. And as I said in the beginning, for someone who's working with cannabis, I think this is really valuable. For someone who's not, just an understanding of what are the kind of metrics that could be measured in a business. And if you work with a different industry, you should know those kind of metrics, Guillermo, just like you do for cannabis. And so, okay, what are those key things that I can influence to a customer and help probably figure out for them how to measure? Because that can be a really gray area that we can bring a lot of order to and help people understand here's the definition we're going to use and we're going to measure it this way to help them see their business in a new way, to work toward that profitability.
That's right. Yeah, and that's something that's really being talked about right now as well, is like what's the optimal technology stack to be able to look at all
Mm.
these different metrics, from your point of sale system to the optimization, and getting all these things to work and talk together and being able to access all this information. So a lot of great tools out there, and a lot of tools keep getting developed to be able to do some of these things that we're trying to do. There's always easier ways to get and monitor this data in a way that doesn't put a huge burden on the operator.
Okay, that's great. Well, Guillermo, thanks again. This has been really educational for today, and I really appreciate what you shared today.
Thanks, Tom. I enjoyed it as well.
Good, thanks. Take care.